This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
In the previous lecture, we saw how it was that in the opening years of a new unincorporated trade, that in addition to the normal loss reliefs available, remember what those normal loss reliefs available are to an ongoing business, i.e. the ability to carry forward a trading loss to set off against future trading profits of the same trade, or to more immediately use that loss by a set off against total income in the current tax year and or the preceding tax year. And if a claim has been made for one or other of those tax years and some loss still remains after that claim, then for that particular year, the year in which the claim has been made, the extension claim can be made to set off any remaining loss, subject to the maximum cap limit that we described, to set off that remaining loss then against the net gains, the net chargeable gains of the year. And as we said, we'll obviously learn far more about capital gains and indeed capital losses when we come to the CGT sections of this particular set of course notes. What we also then saw that was there was a specialist opening year's relief. And what it did was to allow that new business that if it suffered losses early on in its trading, to be precise, within the first 4 tax years of its trading, then a more immediate relief still was given, because it allowed the ability for the individual to take that loss and carry it back and set it off against, yet again, total income, but the total income this time of the preceding 3 tax years. And that was a single claim against all 3 of those years, and we attacked them on a first in, first out basis. We went back 3 years, set off against total income. If the loss exceeded that total income, the balance of the loss would then go against the total income of 2 years ago, and if that was eliminated, then 1 year ago. One single claim against the total incomes of the preceding 3 years on a first in, first out basis. Clearly, giving that new business and individual the ability to get repayments of tax from earlier years, maybe that cash flow impetus that it needs to keep the business going. There is method in the apparent madness there of HMRC by again giving that tax relief, which they give at some point anyway. Maybe it allows some businesses to carry on trading that otherwise might have sadly ceased to trade. And that brings us to the point about cessation of trading. Now, to begin with, we must consider what loss reliefs that we're already aware of would equally still be available. I guess the one that we can start with that would not be available in terms of a cessation of trading would be the carry forward. If you have now ceased trading in a tax year and you have unused losses, there is no future trading profit of the same trade to carry forward to. So clearly the carry forward option is no longer an option in terms of the cessation of a trade. But you've still got your normal reliefs of set off against total income of current tax year and or preceding tax year. And either of those claims, as we know, can be extended in relation to the extension against chargeable gains. And possibly in the final tax year, that's an option that might be a viable one, because when a business ceases to trade, it may do so and yet still have the ability to sell certain of its assets that gives rise to chargeable gains. So the ability to offset a loss against such gains may indeed be a valuable one if there were no other viable use of the loss. But to repeat, we can still set off in that final tax year, just like in any other tax year, against total income of that and or the preceding tax year. We can extend against capital gains, assuming, of course, that the business has been running for more than 4 years, then the specialist opening year's relief would not be an option to it. So in addition to those normal reliefs, you'll see on the screen in front of you that we have the specialist relief available on cessation of trading, known as terminal loss relief. Now we'll be looking at, and you can see there is very little detail that attaches to it. We'll be looking at that in a moment's time. But what I want us to do first is just deal with the cessation. You may recall I asked you to revise through the rules of the bases of assessment in closing years, I want us now to look at a little example I prepared for you, and for us to attempt, or indeed more accurately for you to attempt, to work out the assessments in the closing years. So let's just read through this and you note down the example. Again, you'll be able to pause the lecture whenever you wish. But we are told, Boris ceased trading on the 30th of September 2016, having previously prepared accounts to the 31st of December in each year. Recent results adjusted for taxation were as follows. Now we can see there, as this follows on, that Boris had been preparing accounts as stated to 31st of December, and again I've just given you the recent results. You may assume that Boris has traded for many years, but for the year ended December 14 had made a tax adjusted trading profit of 40,000, and for the year ended December 15 a tax adjusted trading profit of £16,000. Then of course, well, you can see maybe the writing is on the wall for Boris's business, as the profits had slumped there from 40 to 16. But then what finally did for Boris, period to 30th of September 16, a tax adjusted trading loss of 30,000. And it was at that date, the 30th of September 16, as we introduced this example with, that Boris ceased trading. Now, to be able to work assessments, of course, in those closing years, we need to know about the overlap profits from opening years. And there we go, we've got our overlap profits from opening years, and that they had amounted to £8,000. So there's the information that we need to be able to determine what our assessments in those closing years will be. Now, again, what I would like you to do is to treat this like any other cessation. Now, again, I hope that you have revised those bases of assessment in closing years, and you will recall the technique that we now adopt. Remember what we did. What was the first thing that we needed to determine on a cessation of trading? We needed to know, based on this date, the cessation date, what therefore was the final tax year. That you would be able to determine as the 2016-17 tax year as being the tax year in which the cessation of trading actually fell. What we then do is, having determined the final tax year, we note it and move back to the penultimate tax year. Well, if the final tax year of trading is 16-17, then the penultimate tax year must be 15-16, and that year you will assess using CYB. You should be able now to clearly see which of the profits provided to you there would be assessed in that penultimate tax year. If of course there are any prior profits, then they too in earlier tax years will be assessed using CYB. Once you have determined the assessment in the penultimate tax year, then any remaining, well, previously it used to be remaining profit, now of course it may be remaining loss, will be allocated to the final tax year. And we have to bring in our overlap profits. We know that overlap profits, of course, that arose from opening years, they would serve to reduce any profit assessment. Well, of course, they would reduce profits, and yes, they may indeed increase a loss. So, ignoring, as we have not spoken of it as yet, the detail of terminal loss relief, just dealing with your normal loss relief and your normal assessment bases, work out the assessments in those closing years as far as that information provided will allow, and establish what losses are available for relief and how they could be used. Remember what we've said? The business, Boris, has ceased to trade, therefore there is no carry forward. So the options are, quite simply, to set off against the total income of whatever is the current tax year of loss and or the preceding year. Now that's what I'd like you to do, because we should now be able to do that, and then we'll review through it, of course, and see what our outcome should be, and then we'll consider that in addition to those normal loss reliefs, there is another option as to how the loss may be used, and that option is terminal loss relief. That, of course, is a separate exercise, something new, and I will take you through that. But for the moment, pause please and prepare your determination of assessment. Remember, if you have a loss, the assessment is nil, but you must establish how much loss is available for relief and how and where it may be used. Could you therefore, as I've suggested, pause this at this particular point in time and do that work for me now, please. Okay, so let's see what we've done therefore. Again, as we said, firstly determine the final tax year. Cease trading on the 30th of September 2016, therefore, as we said, making 2016-17 the final tax year. If 16-17 is the final tax year, 15-16 is the penultimate tax year. For that we use CYB. Well, which year ended the 31st of December ends in the 15-16 tax year. And there we go, year ended December 15. There will be your CYB assessment for that year. Clearly we can see that we've also got the year ended December 14. That will be again a CYB assessment, but that will be in 14-15, our penultimate year as we've just determined. 15-16 will be assessing the £16,000. That would then allow you to go back to and deal with the final tax year, which as we know is 16-17, putting all remaining figures, here it is a loss figure of 30,000, and with the inclusion also of the overlap profit, put it into that final year. It will be a loss, the assessment will be nil, but that will give you the loss figure. So hopefully following that technique we'll get the following outcomes. Right, as we've said, we would note what is the final tax year, 16-17, then go back to penultimate year, 15-16, and assess it using CYB. We had prepared accounts, Boris had prepared accounts indeed to the 31st of December, so that would be the year ended 31st of December 15. What profit was that figure? Let's just remind ourselves. Year end December 15, £16,000. We would also on this occasion be able to go back to 2014-15, CYB, accounting year ended December 14, and that was where, the good old days, we had a respectable profit of some £40,000 there. But as soon as you've got the penultimate tax year of 15-16, it allowed you then to deal with the final tax year of 16-17. We of course then look at any and all remaining periods as yet unassessed. There is but one. It was that final period through to the 30th of September 16, in which we made a loss of £30,000. We also have our overlap profits. Now, of course, you can refer to it as overlap profits, but overlap relief, and that was £8,000. That therefore gives us overall a loss of £38,000. Yep, that overlap profit, that overlap relief, would serve to not simply reduce a profit, but as we said a few minutes ago, it would also serve to increase or even indeed create a loss. So a loss of 38,000 and therefore an assessment nil. So we now have our assessments clearly determined for each of the years, and we've also identified the amount of loss available to be used under your normal provisions of what can we do with it? There is no carry forward, we have ceased trading. What else can we do? Set off against. I hope you've already written this, of course, in your own answer. Set off against the total income of the current tax year, 16-17. Now, what income might we have in the current year? Clearly, there is no trading income assessment. The assessment is nil. So that will depend on what other income, if any, that you have. Again, if we have other income, having ceased trading at the 30th of September 16, It's possible that Boris, of course, then took on employment and had employment income for the rest of the 16-17 tax year. May have some sources of investment income as well. We need to know what that total income was and whether or not, therefore, a claim against that was worthwhile. Whether it was worthwhile would, of course, depending on the size of the other income as compared to the level of the personal allowance. Set off against the total income of the current tax year and or the preceding tax year, 15-16, where, notwithstanding what other income the taxpayer, Boris, may have, there's a £16,000 trading income assessment. Now, of course, if that's the only income that he's got, it's not going to be a very efficient claim to use £16,000 of loss against a figure of income that could have otherwise have been reduced by the personal allowance of £10,600. But again, we need to know what those sources of other income were. If we have made a claim for either of the two tax years, then for the tax year in which the claim has been made, clearly there may be the possibility of some loss remaining, then that remaining loss could be extended and set off against capital gains of the year. Maybe the most likely year, as we suggested, 16-17, the year in which Boris ceased trading. There may have been assets of the business, a property, for example, a business property, that may be sold off, and that may generate a chargeable gain. So it's a possibility, therefore, that you may extend that claim. But having seen what these normal reliefs are, again, the total income and the extension against capital gains, we now have to consider what the new relief may be. And that one, if we go now back to our notes, that relief is known as terminal loss relief. Now, this one is very different in as much as it demands its own separate and very individual calculation. So let's have a little look at what it does and how we compute it. Right, once we've calculated a terminal loss, we'll see it in a moment, then that terminal loss is set against trading profit for the tax year of cessation. Now, normally, as we have just seen, there is no trading profit in the tax year of cessation because that is usually, as we've just seen, a nil assessment. Because what do we have at its base? We have, of course, a loss. But it is, unlikely though it may be, it is possible that you could have a profit assessment for the final year, but there may still be a terminal loss that has arisen given the way in which we compute it. Again, I do not consider that that is at all a likely option so far as your exam is concerned. So essentially, what it comes down to is, having calculated the terminal loss, we will then set off against, note, the trading profit. This is a carry back, but it's against trading profit, and the set off against trading profit is for the previous 3 tax years. I guess the idea is that because you've ceased trading, there's no carry forward. If you carried forward, you could have set off against the future trading profits of the same trade. So given as that is not any longer an option, they allow you to go back against the trading profits of the previous 3 tax years, this time on a LIFO basis. So in our example, we'll go back to it in a moment's time, we ceased trading in 16-17. We have a nil assessment. Therefore, any such loss relief would now go against the trading income assessment of, on a LIFO basis, the previous 3 years. So that going back from 16-17 would be, in order, 15-16, 14-15, and not that it would be necessary, but as far back as 13-14 there. The previous 3 tax years on a LIFO basis. So that's what we can do with it, but how do we compute it? We've said it's a separate and individual calculation that you perform, and that's what we see now in section B of this note. The terminal loss is very specifically the loss of the final 12 months of trading. But we must divide that final 12 months of trading into 2 parts. It's computed in 2 parts, where we divide the last 12 months of trading between, and we split it between the tax years in which those last 12 months of trading happen to fall. So we divide between the final and the penultimate tax years, calculating it as follows. Firstly, we look at the final tax year, and we look at the actual trade loss for the tax year of cessation, i.e. what loss from the 6th of April to the date of cessation. Again, just as with opening years, some time apportionments will be necessary for you to perform here. So that's the loss, the part of the last 12 months of trading that fall into the final tax year, from 6th of April to the date of cessation. What we also allocate in this part of the calculation is any overlap relief that arose from the opening years. We then move back to the penultimate year, tax year, and pick up for the penultimate tax year the actual trade loss for the period. Remember we said we could go back 12 months for the period 12 months before cessation up until the end of that penultimate tax year. Now, reason why we do it this way, why we do not just lump together the final 12 months of trading into one single calculation, is that in the calculations that we've done, should the result in either one or two come out as a profit figure, then that would be treated as zero, treated as nil, for purposes of the terminal loss computation. Now, it's rare that this would happen, and we'll illustrate it with our example that we've got going in a few moments' time. But let's see how it is, therefore, that we construct that calculation of the terminal loss. Okay, now we'll need to go back to the example that we have running in relation to Boris to do that. Wouldn't be a bad idea if you put yourself to the test at this particular point in time, and you try and do the calculations there that we have defined. What is the actual loss from the 6th of April at the start of the final tax year, that was 1617, through to the date of cessation? Again, a little bit of time apportioned. Add to it the overlap relief, and that is the first part of your terminal loss. You then have to look at what else arose in the 12 months prior to the date of cessation, that part of the last 12 months that falls in the penultimate tax year. Now, what you'll discover, and it's usually this case in exam questions as well, is that you've got partly a profit period and partly a loss period. You need to do those calculations and net out. As long as the net result is a loss, then that is also added into the terminal loss calculation. Should that result have turned out to be a profit, then you would treat it as nil for the purposes of the terminal loss, meaning that just that first calculation there would constitute the entirety of your terminal loss. So, while I therefore get back to that example, I would suggest pause this particular lecture again and see whether you can establish that calculation for yourself. Okay, so let's see what we've got therefore in this separate working headed up as our computation of terminal loss. We have to divide out that last 12 months of trading between the final tax year, 1617, and the part of the last 12 months of trading that fall into the penultimate tax year, which must be 1516. So we cease trading at the 30th of September 16. So we want the loss in the 1617 year, the loss from the 6th of April, the start of that tax year, through to the date of cessation. So how many months is that? That is 6 months. Out of how many months of loss-making period was it? It was a 9-month loss-making period that we had. We had previously prepared accounts to 31st December 15, and this was the 9-month period to September 16. So 6/9 of the loss of £30,000, 6/9 of 30 will be a loss of £20,000. That's the first part. The overlap relief is a given figure. That was £8,000, again if my memory serves me correctly, giving us therefore for this part of our terminal loss calculation a loss within that final tax year of some £28,000. Having dealt with that part of the last 12 months of trading falling into the final tax year, we now cast our net back to the penultimate tax year and pick up the balance of the last 12 months of trading. Well, we ceased trading, as we saw, at the 30th of September 16, so a date 12 months prior to that will be the 1st of October 15 through then to the 5th of April 16. So we've got 6 of the last 12 months in the final tax year, the remaining 6 months fall in the penultimate tax year. Now what of course that does is to pick up a bit of loss and a bit of profit. What we'll do firstly, again it doesn't matter what order you do this in, but if I work back in time, I've already allocated 6 of the last 9 months of trading, that loss-making period of 30,000, 6 of those 9 months to the final tax year. So we now therefore pick up the remaining 3 months of loss. 3/9 of that loss of 30,000 will be the remaining £10,000. So that will go in. But we need another 3 months, the loss basically from the 1st of October 15 through to 31st of December. That is 3 months out of 12 months in which we made a profit of, let's just remind ourselves what that profit was, there, the year end December 15, £16,000. So back to our calculation now, 3/12 of the profit of 16, that's a quarter of that, that is 4,000. And on that basis, therefore, we end up with a net loss of £6,000 to include within our terminal loss calculation. So overall, in total, the terminal loss has come to £34,000. It is that then which can be used to set off against the trading profits of, well, it's a nil assessment in the final tax year, so as ever it's back 3 years on a LIFO basis, so that would be 15-16, 14-15, and if necessary, it won't be, but we could go back as far as 13-14. Now, how do we show that? Let me finish this example first before then coming back to illustrate a few issues. You might have a few questions about the calculation, the result of that calculation that we've got, as compared to the normal loss relief that we computed as being available based on the final tax year of trading. I'll come back to that. But just as we would need to do it in terms of an exam question, we'd then need to lay out the information that we'd have. Again, we'd always recommend in a columnar format here. Now, our final tax year was 16-17, the penultimate tax year 15-16, and the years before that. Now, remember how far back a terminal loss relief can go. From the final tax year 16-17, you can go back 3 years. So in an exam question, you may be given information about the previous 3 years. In my example, I've only given you information, we'll see why in a moment, for 15-16 and 14-15. But it could go back, and be prepared to deal with it here, back 3 years to 13-14. What we have would be our trading income assessments. That is nil in 16-17. It was, I think, 16,000 in 15-16, and it was 40,000. At least I think it was 40,000. Let's go back and check that. Yeah, there we go. £40,000 for the year ended December 14, and that, of course, is what we assessed in 14-15. Now, again, you may be given an exam question of an equivalent figure. All you've got to do is pick it up and put it in for 13-14. Now, it is against that trading income that your terminal loss relief would apply. But then, of course, on your computation, your income tax computations, you would be including any other income to bring you down to your total income. And that total income, same as net income here, would be reduced by your personal allowance to bring you to a bottom line figure of taxable income for each of these tax years. Now, all we'd need to do is to show how and where the terminal loss relief would be applied. We've calculated how much terminal loss has arisen. There it is, £34,000. There's a nil assessment in 1617, so there's nothing there. We've got 34,000 available in 1516, therefore the £16,000 will be entirely eliminated. Again, you can show a separate working of this, how and where you've used it. A little loss memorandum, remember. 16 has been used out of £34,000. 16 out of 34 leaves £18,000. That, of course, will then be fully used against the 40,000 and still leave some £22,000 worth of net trading income assessment. If the remaining loss had been bigger than 40, then of course all of the 40 would gone and would have gone back against whatever trading income assessment there was in 1340. If after that there was still loss left over, then that would not be usable under terminal loss, and we'd have to see whether any other loss relief might be available to us, the point of which I'll come back to in a moment's time. But that's how you demonstrate the use of the terminal loss. If they wanted you to work the taxable income figures, then you'd pick up any other income for these years, add it in to give you the total income, take away your personal allowances, we'd be assuming a standard, of course, here £10,600, take it away, and you'd come down to your taxable income figures there. So that's the basic structure of any answer that the examiner may wish to have, at least within a written question. That's how we'd lay that out. Clearly an objective testing question, we're just going to try and calculate the answer and put that answer in. Alright, now what we've seen there is that terminal loss, separate calculation, gave rise, as we've just seen, to a loss of £34,000. Now, the reason why I'm flagging this up is the reason why I started our discussion of losses in closing years by looking at what the normal assessment calculations would be and what loss that would give rise to. And what we saw here at the outset of this calculation was that the actual loss made that could be set off against total income in current and or preceding tax year was £38,000. That compares favourably to the £34,000 that we've just calculated for terminal loss. What that would mean is it's down to the taxpayer to choose what options they wish to pursue. But if they did claim, if Boris here did claim his terminal loss relief, his 16,000 15/16 and 18,000 in 14/15, had he made those claims, then he would have used 34,000 of loss out of an actual loss for the final tax year, 16/17, the final tax year, of 38. So what we could then note is that there would still be £4,000 worth of loss remaining. We've used here 34,000 under terminal loss. We've already calculated that there is an actual loss of 38,000, so that difference of 4,000 could now be used to set off against the total income of the current tax year and or the preceding tax year. Now, these would be your total income figures here. Now, of course, that total income in for the final tax year, given that we've got a nil assessment, may be less than the personal allowance. So using the other £4,000 of loss against that total income would be meaningless. Here, of course, in 15/16, again, we've come down to no trading income. So if that other income is again less than 10,600, then the use of the loss in that way is going to be meaningless because it will not actually take out any income that would otherwise have been taxable. But if either of those other income figures had gone above 10,600, gone above 10.6 by an amount of 4,000, then yeah, an additional tax relief would be available to you. Okay. We've now seen the various loss reliefs available to an unincorporated trader, and those that may be claimed from the word go from the very first tax year onwards, and if it is opening years, in addition to the normal reliefs, the specialist opening years relief. The normal reliefs then extend through to the final tax year in which we ceased trading, But then in addition to the normal reliefs that may still be available to you, you've got the specialist terminal loss relief. You must be aware of what those losses are, how you calculate those losses, and how and where you may relieve them. Also remember what our objectives were in terms of tax planning. We want to get the best use out of a loss. Now we know that losses reduce income. Well, we would far rather reduce income that falls within a higher rather than just a basic rate of tax, so that the loss when used removes income that would otherwise have been taxed at 40% rather than merely taxed at 20%. Can we get relief at higher tax rates? What we also want to do, as has come up so many times in our workings, we want to avoid wasting the personal allowance. The only snag also that we may see in terms of avoiding wasting the personal allowance is that in situations other than a cessation, that might mean that we're going to choose to carry forward the loss rather than relieve against total income in current and or preceding tax years. Now that means that if you carry forward rather than using the loss now, then you don't get the cash flow advantage. And that was the third objective of regarding the best use of losses, cash flow. We would like to be able to use the loss sooner rather than later. If I can carry back to an earlier year, I will get a repayment of tax paid in those earlier years. If I use it in the current year, then I will not have to pay the tax that would otherwise have been payable for the current year. But that is a payment still to be made. And if I carry it forward, then I won't be able to gain any use of that loss until the date arrives where I would in the future have otherwise have paid that tax. So consider and be able to note down in your answer, obviously in a written question here, what these objectives would be. Relief at higher rates, avoid wasting the personal allowance, and if you can, gain relief at the earliest available opportunity, and that is for cash flow purposes. Okay. In your notes, you've got an example 6, David there, that ceased to trade. I'd like you to have a little go at that, please, on your own. Before then, having dealt with Chapter 7, we will move together to Chapter 8, where we will see a combination of many of the things that we have already done. Up until this point in time, the unincorporated trader has been a single individual. He or she has operated as a sole trader. But we've said all along that unincorporated trades may either be sole traders or indeed be partnerships. So what we've got to then look at in Chapter 8 to complete our studies of the unincorporated trader is how we deal with partnerships, where it will be a lot of what we have done before. Remember Chapter 4, adjustment of profits. Well, the partnership statement of profit or loss is adjusted in just the same way, adjustment of profits. Chapter 5, capital allowances. Capital allowances, remember, computed and deducted in relation to the period. We do the same for a partnership. We adjust up the statement of profit and loss of the partnership, we compute and deduct the capital allowances of the partnership, and we end up with a tax-adjusted trading profit, or indeed loss as the case may be, for the accounting period, whatever date the partnership has chosen to prepare its accounts to. Now it's at that point, following adjustment of profits and capital allowances and determination of tax-adjusted, let's assume to begin with, trading profit, that profit then we used the rules in Chapter 6 to determine the bases of assessment, be it normal CYB or be it opening or closing years rules. What we now discover, or more true to say in the next lecture what we'll discover, is that we do not tax the partnership. Instead, we tax the partners. So what it will be essential to do is to take that tax-adjusted trading profit of the partnership and firstly divide it between the partners. Divide it between the partners so that each partner has their own share of that adjusted profit. And then we will tax each partner in turn as you would any unincorporated trader, any other sole trader. If it's a continuing business so far as the partner is concerned, he or she is a continuing partner, CYB. If it's a new partner coming in, that's a new business, so opening year's rules will apply to him or to her. And if a partner leaves the partnership, then that's a cessation, so far as that partner is concerned. And on that basis, therefore, closing year rules, bases of assessment will apply. In the same way as we divide out a profit between the partners and assess each partner on their own share of that profit using our normal bases of assessment for individuals, so it is that if the partnership made a loss, we would divide out the loss of the partnership between the partners, and then each partner would be free to make their own individual choices of the loss reliefs available to them and set off against whichever sources of income they choose, whether that be set off against total income, current and/or preceding year, with the potential extension claim, be it a carry forward against their own future trading profit from that partnership, or if they're a new partner, the specialist opening year's relief. If it's a partner leaving the partnership, then the terminal loss relief would be available to them. Now again, I just mentioned that at the end of this session. I would suggest that you go back over the last 2 minutes of discussions that I've just had with you prior to us picking up on the next lecture together on Chapter 8.